The impact of inflation on your investments. Hey everyone, welcome back to our channel. Inflation, the silent force that erodes the purchasing power of money, plays a pivotal role in shaping the economic landscape. As prices rise, the value of currency diminishes, affecting not only the cost of goods and services but also the performance of investments. In this video, we delve into the intricate relationship between inflation and investments, exploring the impact it has on various asset classes and strategies to mitigate its effects. Understanding inflation. Inflation is the rate at which the general level of prices for goods and services rises, leading to a decrease in the purchasing power of a currency. It is a natural economic phenomenon influenced by factors such as supply and demand dynamics, government policies, and global economic conditions. Investors need to recognize that inflation is an inherent part of the economic cycle and can significantly impact the real returns on their investments. Impact on fixed income investments. One of the most direct impacts of inflation is felt by holders of fixed income investments such as bonds. Fixed income securities, including government and corporate bonds, offer a fixed interest rate. When inflation rises, the real return on these investments decreases. For instance, if an investor holds a bond with a 3% interest rate and inflation is running at 2%, the real return is only 1%. In times of higher inflation, the fixed interest payments become less valuable, leading to diminished purchasing power for bondholders. Strategies for fixed income investors. To combat the eroding effects of inflation on fixed income investments, investors can adopt several strategies. One common approach is to diversify bond holdings to include inflation-protected securities, such as Treasury inflation-protected securities, TIPS. These securities are indexed to inflation, providing investors with a hedge against rising prices. Additionally, short-duration bonds and floating-rate bonds can be considered, as they tend to be less sensitive to interest rate changes and offer some protection in inflationary environments. However, investors must carefully assess their risk tolerance and investment goals when implementing these strategies. Equities and real assets as inflation hedges. While fixed income investments may face challenges during inflationary periods, equities and real assets have historically been viewed as better inflation hedges. Companies with strong pricing power and the ability to pass on increased costs to consumers may see their earnings rise in tandem with inflation. Investing in sectors that are traditionally less impacted by inflation, such as healthcare and utilities, can be a strategic move. Furthermore, allocating a portion of a portfolio to real assets like real estate and commodities can provide a tangible hedge against inflation. Real assets often have intrinsic value and can serve as a store of value when traditional currency is depreciating. Diversification strategies. Diversification remains a cornerstone of sound investment strategy, especially in the face of inflation. A well-diversified portfolio that includes a mix of asset classes can help spread risk and mitigate the impact of inflation on overall returns. Combining equities, fixed income securities, and real assets in a strategic allocation can enhance the resilience of a portfolio during inflationary periods. Gold as an inflation hedge. Gold has long been considered a hedge against inflation and currency devaluation. Its intrinsic value and limited supply make it an attractive option for investors seeking to protect their wealth during times of rising prices. Gold has historically demonstrated a negative correlation with fiat currencies during periods of high inflation, making it a popular choice for investors looking to preserve capital. Inflation-linked investment strategies. Investors can explore specific strategies designed to capitalize on inflationary trends. This may include investing in companies with strong pricing power, dividend-paying stocks, and inflation-linked bonds. Dividend-paying stocks can provide a potential income stream that keeps pace with inflation, while inflation-linked bonds adjust their principal and interest payments based on inflation rates. Risk management and monitoring. In an environment where inflation is a concern, active risk management becomes crucial. Regularly monitoring the economic landscape, central bank policies, and global trends can help investors stay ahead of potential risks. Maintaining flexibility in investment decisions and being prepared to adjust portfolios in response to changing market conditions are essential elements of effective risk management. Furthermore, investors should closely track inflation indicators, such as the Consumer Price Index, CPI, and Producer Price Index, PPI, to gauge the magnitude of inflationary pressures. In addition to macroeconomic factors, geopolitical events and trade tensions can significantly impact inflation expectations. It is imperative for investors to stay informed about global events that may influence inflation dynamics. Utilizing advanced risk management tools and analytics can provide a more nuanced understanding of portfolio vulnerabilities in the face of inflation. Establishing contingency plans and stress testing portfolios under various inflation scenarios can enhance preparedness for unexpected developments. Ultimately, a proactive approach to risk management, coupled with continuous monitoring and a willingness to adapt strategies, empowers investors to navigate the ever-evolving landscape shaped by the forces of inflation. Government policies and inflation expectations. Government policies, particularly monetary and fiscal measures, play a significant role in shaping inflation expectations. Central banks often set interest rates to control inflation, and investors should closely monitor these policies. In times of anticipated inflation, central banks may raise interest rates to curb rising prices. This can have ripple effects across financial markets, impacting various asset classes. Inflation's impact on investments is a multifaceted challenge that requires careful consideration and strategic planning. While fixed income investments may face headwinds during inflationary periods, equities, real assets, and inflation-linked strategies offer potential avenues for preserving and growing wealth. Diversification, risk management, and a keen awareness of government policies and inflation expectations are crucial elements for investors navigating the complex relationship between inflation and investments. By understanding these dynamics and implementing thoughtful strategies, investors can position themselves to weather the challenges posed by inflation and pursue their long-term financial goals. If you found this video helpful, don't forget to like and subscribe for more exciting content. Thanks for watching, and until next time, keep chasing your dreams.